Good afternoon, everyone. Welcome back. This is 34th webinar. We call it Lawgical Talk, and this is the 34th edition. We should soon be completing 3 years now in May. And Welcome back. At this time, we have come back with a topic which impacts almost all of us. And I was just thinking, what do I call this topic of income tax? We are always in a dharma sankat. We call, should I think from my company perspective or should I think from my individual perspective? Always the heart and brain start taking colliding with each other. Should I put myself first or the organization first? So because this is one law which possibly impacts each one of us, very personally. Possibly that's a law which we would have started seeing or noticing as a child also, because it was getting discussed. The only time we read, I remember only time I read news, economic times as a child was the next day of the budget speech, budget session. So that's pretty close to us. So let's quickly let me quickly run the slide more to of a customary, and I'm sure again you would know what I'm going to talk. A quick introduction about Lawrbit. We are we are India's leading regulatory technology company, serving clients and rather helping clients uh, in automating their compliance monitoring processes, not just in India but globally as well. Our flagship product, called as GCMS, Global Compliance Management Solution, is being used by our clients in across the globe. We have served clients in around 70 plus countries, and today we are working with serving clients in 40 plus jurisdictions and serving around 650 plus entities and 4,000 plus locations in these countries, and possibly you name an industry, and we are serving clients in those industries. We have a massive library of laws and compliance across these countries, which we are keeping it updated on a real-time basis. And we are a team of 105 professionals, legal and tech professionals, who are helping you stay compliant with all the laws at any point of time. Beyond regulatory compliance, we also help you with managing your litigations, down your audits and your IFCs, and also keep helping you with regulatory compliance, health checks or audits during this process. So that's a quick introduction about ourselves. And with this, let me just quickly jump onto the agenda for today and introduce you with our panelists. I'll start with Sai. Sai is a chartered accountant and director of First Partner Consulting. As I mentioned, he's a chartered accountant. He also holds a diploma in information security audit and a member of Institute of Social Auditors of India. He's also certified in foreign exchange, FEMA, and has command over global regulatory and financial operations. And he has worked and has experience in varied industries. And some of those important topics which we are going to discuss today will be taken up by Sai. We also, hi Sai, thank you so much.
Hi, Nihit. Hi, good evening.
Good evening. In order, we have Sandeep Bagwar. Sandeep is the co-founder and partner with DS Advocates. And Sandeep is also a lawyer from ILS Pune. He has written multiple articles. He has assisted in editing editions of Kanga and Pakliwal's Law and Practice of income tax for next in 2014 and 20. Sandeep, a lot of my team members are alumni of your college. Definitely your your juniors though. And I have my colleague Shweta also joined in today. She leads our regulatory intelligence team and alumni of your ILS Pune. And so she's excited to hear to listen to you. I don't know whether you interacted with her during college or not, but yes, she is. And my partner Dilpreet was also an ILS alumni. And then we have Saurabh, catching him the most difficult task. So he has made us work in the evenings, and I'm sure Saurabh, you're giving tough time to your team also. Two things very common here with Saurabh. Saurabh is also alumni of Queen Mary, University of London, and sort of one of my colleague, Trishul, you interacted with. She is also your alumni in your college, while again you're senior junior, and Saurabh is going to be talking about some of those important aspects on the income tax, and we have intentionally kept his slides for the last so that he stays with us. And Saurabh is also a serious litigator. He has represented clients in forums, in different forums, and practiced across different jurisdictions, not just in India, in Africa as well. Excited to hear from you. And like before I start, I'm going to admit that this is one subject while I would say we all are aware of, but I am very scared of. I don't understand income tax, so I'm being more of a listener to this conversation today than participating anywhere. So let's start with this. Let's get going. So what we are going to cover, and again, before we jump onto this, for everyone, I just want to talk about, because this is the income tax. What has what has come recently? The 1 hour, 15 minutes, 20 minutes is not sufficient for it. So what we are also planning to do is we are planning to have one more session on this topic. Maybe in the following month, we will continue the series. We will not wait for a month long, but we will try and do it faster post Holi. But we are going to touch upon some of the important aspects. What the changes have been brought in this budget, how it's going to get impact, what kind of impact we have. We are going to talk about the important compliance, the policy shift, also into through this budget. Decriminalization and litigation framework, but this is something very important from the corporate standpoint. We are, and that's something which I think the government has been constantly working towards it, and that's not just in income tax, but we are seeing this as an endeavor and attempt from the government side to decriminalize a lot of provisions in different laws, and very good thing in income tax, which impacts everyone. Government has brought changes. What are those changes? We'll talk about it. And then we're also going to talk about foreign asset or small taxpayer disclosure fast scheme 2026. And during this process, we will also try and take up some questions. As you are aware of this format, in between you have any questions, please feel free to put them on the chat. If our team has some pointers to share, we will also try and put those on the chat box as well. Let's keep it active, and let's start the discussion. Sai, I would want to invite you to start with. Sorry, Sandeep, I want to start. Invite you to start with a overview. What is the change? How and why is it changed?
Hi, good evening, everybody, and very happy to hear that a lot of ILS alumni and seniors and juniors from ILS are here to hear me. From a 2010 batch, so there'll be obviously seniors and juniors, a mixed bag of people, and good to have a good panel around Sai and Saurabh. So let's give you a perspective of what was earlier and what is going to be tomorrow, and what was the past, and how we are going to transit ourselves with scheme of things, right? So let's just step a little back, because a lot of people are not really conversant with income tax so much. So let's just give you a complete, very short, good history about entire income tax system, of how the legislation transpired. Okay, the entire travel history. So let's look at the Income Tax Act as such. Initially was started in 1860, right, in the India. And that was for necessary because pursuant to revolt of 1857, the British Raj was short of funds and they wanted some money, right? So that's when the income tax was first introduced under this Indian subcontinent in 1860. Thereafter, there will be three types of taxes, where license tax was introduced, certificate tax was introduced, and thereafter we used to call the license Raj. License Raj is nothing but basically the erstwhile license tax of the British period, right? And thereafter 1869, then 1886, And in 1918, that is the first time there was a proper codified law, right? And thereafter it became the 1922 Act. In the 1922 Act, we had what we presently have in the 1961 Act, but in a very short form, right? So it was there. And from the 1922 Act, 40 years transpired, and then they said, no, that law has become complex and we need to amend the law. We need to have a simplified law. And then there came the 1961 Act, right? So the 1961 Act has been there for almost 6 decades now. And we have a quite exchequer history of the 1961 Act being amended every year, right? So the intention of the 1961 Act was to bring about a more simplified law, but our government being government kept tweaking it, kept amending it. Every year we saw in the initial first 2 decades, you would have seen 20, 30 amendments as time progressed, 60 amendments as time progressed, 100 amendments every year, right? And there was a time when we had repeated retrospective amendments also into it. And we also had amendments which overruled certain decisions also. So that became kind of a practice in the 1961 Act. And like as Mr. Palkiwala used to put it, that Income Tax Act was a disgrace, national disgrace, because it has overseen around about even 5,000, 6,000 amendments over the period of time, right? So it was Mr. Palkiwala who always been fought. And like if somebody hears Mr. Palkiwala, like a stadium full of people hearing him, so he was always vocal about his views on how the tax landscape has changed in India, right? So we had the 1961 Act that has become passed now. In between, we had a time where in 2009, the DTC was supposed to come, again with the same motto, simplified tax legislation and so forth. Anyway, the regime changed and that was dumped, and the new regime came in. And in 2017, they all came in together. Let's have a simplified tax law, and then the simplified tax law had in the form of the 2025 Act has come in. And today we are going to have from 1st April 2026, we will have the Income Tax Act 2025 in place. Obviously, it had gone to a rigmarole of a select committee wherein tons and tons of people came in and poured in recommendation. And frankly, just to give you a brief view of what happened before the select committee is that select committee heard hundreds and hundreds of people, associations, industries, professionals. So many of them came in and so many of them pitched in that this is the way you need to simplify. This is indeed you need to rationalize. And if somebody has academic interest and wants to read through the select committee report, I'll give you a nutshell. It's just very simple. Select committee said, yes, all these recommendations are well taken, but our task is only to simplify law and not to make any policy changes. Sorry, your changes we will not accept it. So that's when it is. There were a few changes which were ultimately accepted, with not on policy basis, but on some grammatical mistakes or some lacuna in the legislation. Those kinds of things were accepted by the committee and ultimately were again accepted by the finance ministry. And that's when you have now the Income Tax Act 2025, which will come in force on 1st April 2026. And look at the irony. Committee said, no policy change, nothing. And the recommendations which were placed before committee at that point of time for a series of 3-4 months, today some of the proposals made by the professional associations have been accepted and brought in by way of an amendment by the Finance Bill 2026. You could have done that in the at the time itself, rather than amending the law. Today we all have bought the Income Tax Act 2025, and again we have to buy it again. So it's just gonna be a colossal waste. But ultimately, today it's a simple regime, easy law, and so on and so forth. You could have done it in the first place. You did not have required to have about 87 amendments to a law which is not even born. So this is where a base trajectory of the 2025 Act. And now what is 2025 Act is in store. So the new 2025 Act comes into force from 1st April 2026. Right. So you have, as against 820 sections earlier, we have around about 536 sections today. Instead of 14 schedules, we have 16 schedules. The draft rules have also come into public domain. Again, subject matter of, recommendations, and again, the select committee or the finance ministry will look into the recommendations. So today we have around about, in draft rules, about 333 rules, 190 forms, as against 511 rules into the 1962 rules. And earlier we had about 399 forms under the old rules. Today we'll have about 190 forms. So this is a complete change. We will have a new species, new Income Tax Act. The only hope is that two ways of looking at it. Yes, it gives immense work for everybody as a professional. It's a good learning exercise. If somebody wants to take up Income Tax Act today, yes, please, you have a new act, please take it. As far as industry or stakeholders are concerned, the one hope is that things which have already been settled, the decisions which have already been settled under the 1961 Act, we hope that under the 2025 Act, the government accepts and then continue the judicata principle applies. It should not become the case that in the 2025 Act, the officer says that, no, it's a new act, I have the right to reassess it again. So that's something which we hope for. And in terms of the entire trajectory of the 2025 Act, the scheme of the Act remains the same. We have the same five heads of income, that is salary, house property, business income, capital gains, and income from other sources. You have the same return scheme, same TDS regime. Overall, the structure remains the same. There's no change in the structure. It's the language has changed here and there. Instead of using notwithstanding, you have used irrespective of, and instead of having explanations and provisos, we have all converted into subsections. So today you don't have any explanations and provisos in the new 2025 Act. So that's a brief overview of the entire things which we stand today and which we are going to start implementing from 1st of April 2026. The rates of change, there is no change in the rate system as such. The income tax for individuals remains the same. The slab rate remains the same. If you structure your tax planning well, up to an individual having salary of up to 12.75 lakhs can be exempt from taxes, subject to rebate and standard deduction of 75,000. So that's about for an individual in place. Otherwise, your tax regime remains the same. There's no change. Yes, you have a concessional rate of tax also in place. And as we will see how other changes have been brought in by the Finance Bill 2026. So this is the rates for the cooperative society, firms and companies. So it's predominantly remains same, 20 to 25%, 30%, 35% with surcharges as the case may be. And whoever opts for the concessional tax regime, which is 20, 22%, depends on that. Yes, they have to forego their incentives, right? You have a flat rate of 20% on your profits.
So Sandeep, what I'm understanding from an individual standpoint, there is no change for me vis-a-vis what was there last year, right? So from an income tax standpoint, there has been one more from an individual perspective specifically. I think there has been one more major change with the introduction of labor codes, right? The salaries structures have to be reworked, and that may impact some type of allowances. Does it make any difference to me with in view of those labor codes and the restructuring of salaries, or for me, whatever uh, tax were applicable, it's all same?
So as far as income tax is concerned, there's no change for the salaried employee. It's all remains same. So whatever your PF contributions or everything, it changes, it's still taken care of. So ultimately, if the point is whether you want to remain in the old regime or you want to go to the new regime, that's the decision which you take. If you go to the new regime, you have a 12.75 lakhs of exemption. Up to 12.75 lakhs, you don't pay tax, and thereafter you have your slab rates applied. Right, so that's something which you have to tax plan. But in terms of your labor code, vis-a-vis income tax, there's not going to be any impact.
What's your thoughts on the government's uh, idea or intention behind still keeping the old tax regime? You think?
So my personal view is, I personally, if you ask me, I'm personally still under the old regime. Though the new regime is still beneficial to me in terms of tax savings, I ultimately, if I put it around about people who are in the bracket of 20 to 30 lakhs, right? So for them, it's a decision making. You will save a few thousands, or you might lose few thousand. But people who are below 20 lakhs, they are good with the new regime. But if somebody who's using all their benefits, right? Say your LIC exemptions, your PF contributions, your health insurance, whatever exemptions which use to benefit deduction, which used to get under Chapter 6, say people who are making donations. If somebody who wants to still continue contributing, continue build a corpus, continue to build a saving system, then I would still recommend them to retain in the old regime. You take the benefit of all your deductions and benefits, build a corpus, and you probably you might save some taxes, some depending on some your final income, or you might pay a little higher. But marginal, it's ultimately it's a marginal difference in that sense. So it's completely a conscious call of an individual whether you want to continue doing this detection. Because let's look at it from an Indian perspective. People are like, earlier people used to put into these deductions to save taxes. Now that has been done away with. That is the most important factor. So if you want to inculcate a habit like yes, earn and spend, go to the new regime, earn and save, continue in the old regime. No difficulty.
Yeah, I think that's a very interesting line. Right? Is that earn and save? That's a thought process because some of these benefits and all which are away in the new regime. And if people have started, people are invested substantially, then I think makes sense. Thank you. This is helpful. Let's move to the next, part of the discussion. The budget 2026. What are the policy shift? What kind of impact will have on the compliances, and what's the way forward? And from both from individuals as well as the organizations. I want to invite Sai to come and give us some thoughts on this particular piece.
Yeah. Hi, everyone. Good evening, all. So, till last income tax in 1961, we had a provision where the employee's contribution to PF was disallowed if it is paid after the due date. But whereas with respect to employer contribution, we have the time limit till to file the income tax return. But if you consider the PF regulator authorities, there is no distinction between employee contribution and employer contribution. Anyways, the PF return needs to be filed employee and employer both combined. But only where in the income tax was separately employee contribution deduction is separate and employer contribution deduction is separate. There was a lot of legal challenges battle happened in the last couple of years approximately across all high courts and supreme courts. Now this income tax 2025, they plugged this where the employee contribution disallowance, if it has paid after the due date, which is as per the PF Act or ESA Act, there is no disallowance. If it is paid along with the income tax return as specified in the income tax due date. That is, the employee contribution and employer contribution has same treatment in the income tax 2025. So that there is no permanent disallowance for with respect to if the employee contribution was paid after the due date. So it's usually welcome, and also this definitely benefits all the companies where if any late payment was happened by mistake for any PF contribution, they will not have any permanent disallowance.
I think that was also adding to the complexity of keeping a tab on, because sometimes it's not an intentionally delay. There are some for some reasons the calculations and all, there were delays. It may not be a bigger delay, but the couple of day delay also was was impacting the organizations.
Yes, and particularly the employer contribution is a temporary disallowance. For example, if you haven't paid this year, and if you have paid the next year, you are eligible to claim the allowance in the next year. But whereas employees, the deduction is only permanent disallowance in the previous year regulations. Now they have made it to the temporary disallowance if it is paid within the income tax return due date as per the new section, which is 31st August or 30th September, whatever it is applicable, then the company or the business person can able to claim the deduction. The next major change, I think there's a very big change with respect to the MAT provisions in the income tax 2025. So before we move to this, what are the new changes? Let's understand what exactly is the previous scenario. Now, for the domestic companies is concerned, we have two regimes. One is the old regime where you can able to claim all additional depreciation, specified zones reduction, extra family expenditure, what extra allowances you can able to claim. Whereas in the concessional tax rates, which is the old sections, if I can refer, because people are very familiar to that, which is 115 BAA or 115 BAB, where we have concession tax rates of 17%, 22%, 21%. Where the companies which opted for concessional tax rate, there is no MAT at all. Still, the stands same. There is no amendment for that. The amendment is applicable for the companies who have been in the old regime and they're paying MAT. This amendment is more concerned for that. So now, take a company which is under old regime where they're paying MAT for a couple of years, which is at 15%. The earlier they can able to use this MAT rate for the next 15 years from the rate which they have paid the MAT tax. Now they made an amendment that whatever the MAT tax they paid, that's the final tax. There is no MAT credit that they can able to use in the next years. This is a very big move by the income tax department. There is no MAT credit allowed in the future years for by the any companies which are under old regime. There's one catch here that any company that wishes to move from old regime to new regime, okay, then the MAT credit as on 31st March 2026, then they can able to use that accumulated MAT credit in the next in the next years. So if the company still wants to continue under the old regime, what are the MAT credit that they paid in the that they're going to pay, which is at 14%, they cannot get that as credit. And what are the MAT credit that they paid, which was till 31st March 2026, which is at the 15%, that 15% MAT credit is allowed to the domestic companies which opt from old regime to new regime. But there's a limit for that. The limit is 25% of the tax that they're supposed to pay in the next years. Let's take an example. For example, till 31st March 2026, the MAT accumulated credit was 100 rupees. Okay. Now, there's a new tax year. For the tax year 26-27, the company is supposed to pay tax under new provisions because there is no MAT in the new provisions. So that is 25 rupees. Now 25 of 25 is only they can able to claim as a credit, not 100 of 1/4. Okay, what are the tax that they are supposed to pay on the total income? On the 25th of the first 25% they can able to claim as credit, but subject to the total credit cannot exceed more than 15 years. Because any MAT credit, that maximum they can able to carry utilized only for 15 years. So this is a big shift for all the companies where moving from old regime to new regime. And this helps the companies to smooth transition from old regime to new regime where they can able to use this credit. But one more catch here which we should notice. For the foreign companies, yes, the MAT credit is, there is no bar, they can still able to claim the MAT credit. There's no bar on that. Only for the domestic companies where they're shifting from old regime to new regime, they can able to use the MAT credit as of the 1st March 26. If they want to still continue the old regime, they're supposed to pay MAT tax at 14%, but there is no credit on the 14% tax what they paid. I think it's an example. So if I look into this, so the old framework, which is at 15%, where we have the book profit is worth 120 crore and the tax payable is 18 crores. Now, in the new framework, which is I'm saying the new framework, new provisions of amendment, the tax payable under MAT provision is 16.8 crores. The point we should understand is this 16.8 crores is not available for credit utilization of future years. Only what are the MAT credit they paid till 31st March 2026, that is still 18 crores. They can able to use that credit if they want to convert from old regime to new regime. But what are the MAT tax under 14%? You can't use that credit because that's a final tax. There's no more credits on that. So one of the interesting amendment, if you want to understand on the buyback tax. So starting from long run where the buyback was taxed in hands of shareholders, and then it moved to companies, and then it was to move to shareholders, and then companies. All the cycle was plugged. Now, ultimately, if you want to understand, the buyback is taxed in the hands of shareholders. So let's understand from the 3 recent amendments. Before 2024, the buyback is taxed at the company level, especially for private limited companies, where it is 20% plus surcharge, which is the old section 115 QA. Where the hands of shareholder, there is no tax on buyback. Only the companies to pay tax, the promoters have enjoyed that. After that, after October 2024, which is the Finance Act second Finance Act number 2 2024, the amendment was made such that the buyback is taxed in the hands of shareholders as a dividend. So they considered this buyback provisions as a dividend, but not as a capital gains. So what happened? This buyback amount, whatever it was received in the hands of shareholders, that is taxed as a dividend in income from other sources, and the cost of acquisition to acquire that shares is parking as a loss in the underhead income from capital gains. So if you understand that, let's assume an individual who is not having any income from capital gains, then this loss will be unutilized capital gains. Unless you have a gain from any capital gains in the future years, this loss is an exhausted loss. He can't able to utilize that. But still, he need to pay tax under dividends. So now this is a one pain that was being bared by the different promoters and unlisted equity shares. Now, to curb this practice, to understanding the practical challenges in income tax what we have in the last couple of years, now the new amendment is whatever the tax on the buyback, it is paid under the capital gains. Simple. For example, if the company has buyback its shares, what are the amount that is received by the shareholder? It is taxed in the hands of shareholder. Total amount received less what are the cost of acquisition in the balance tax. But the catch here is, for example, the as I said, it is under capital gains. If it is short-term capital gain, as a normal provisions, it is at 12.5%. If it is 20%. If it is long-term, it is 12.5%. Now, the government has made a clear distinction that in case of domestic companies, okay, in case of domestic companies, if it is in short term, let's make effective as a 22%. If it is short term or long term, in case of domestic companies, they want 22% as tax. So they have increased the tax rate for that. So if you understand, the domestic company needs to pay 22% as effective tax rate if they got any amount from buyback of shares. Other than domestic company who are the promoters, they are supposed to pay 30%. That means, for example, I'm a promoter, okay, where I got money from by exercising buyback option. Let's assume it's a long term. Being it's a long term capital gain, I'm supposed to pay tax at 20%. That's what the rule says, section 112. Now, due to this new provisions, I need to pay tax 10% extra, 20% plus 10%. That is effective 30%. If it is a short term, 12.5% plus some 17.5%, which has become to 30%. So whatever the case it is, as an individual, I was supposed to pay effectively 30% as capital gains tax. If it's a domestic company, it is 22%. So that's where the unexhausted capital loss, which is being looked for in the last couple of years, that has been answered by new amendments.
So Sai, how would this be treated in the company's account books, which company which is doing this buyback, which is buying back these shares? How will it be treated in the company's books? Is there any change in that, or
It's pretty normal because no, anyways, the company buyback its shares. So what are the valuation that normal provisions it will follow, and the company will sell its own shares, which the capital will get reduced, and what are the amount they can buy back, the cash will outflow. So from the accounting perspective, there is no change, even the earlier or before. The only change that before 2024 was the company was private limited company, if you can say, they were supposed to pay 20% as tax earlier. Now there is no burden on the private limited companies for the tax because the taxation incidence was changed from the company to the shareholder level.
and earlier it was okay? Understood. Okay. Sandeep, you want to add something here? Saurabh?
So I'll just couple of things as far as MAT is concerned. So my personal view is that MAT, like giving, it's not a beneficial the amendment which they have done. Basically, you are trying to force companies to go into the new
Convert from
regime.
one.
Yeah, that is one. And second, yes, there is going to be likelihood of challenge because what happens is that once you force somebody to a new regime, then you lose your deductions, right? Why the MAT was introduced was the purpose of MAT being introduced was that companies which were high capital growth companies and were claiming deductions, say SEZs, and then you had industrial undertakings or in undertakings situated in Northeast. They were all given concession tax reduction, 100% tax holiday for 5 years, 10 years, 15 years, as the case may be. So they were not paying taxes. So you imposed MAT on them. So they had MAT collected with them, right? So MAT tax, which they had a credit. So that MAT credit became an asset for them because they could have utilized this in future. Now you are forcing those people who are into a deduction regime or who are already into deduction regime and who are still deduction is going to continue, right? So let's take a startups example, right? 10 out of 10 years, you can take 3 years of deduction, right? So ADISC 7. So you had 3 years of deduction. Let's assume a startup company who was anyways supposed to pay MAT, who had the credit, he would have planned his affairs in such a way that, yes, don't worry, I'll pay MAT now, 15%, I'll take credit tomorrow, no difficulty. But now you have forcing somebody, if you want to take credit, come to the new regime, then take the 25% credit, right? Otherwise, you don't get it. Now, what happens is a startup which had still 2 years of deductions left, he will probably want to forego a deduction. If I don't go into the new regime, then I have to, my MAT becomes a 14% cost to me, no credit. If I go to the new regime, the deduction which I was supposed to enjoy, I will not get that deduction. So that's something which is a disturbing feature which should not have been done. That could be a possible room for challenge where people might challenge it on the grounds of legitimate expectation or even withdrawing somebody. It's a forceful amendment, right? And the MAT credit ultimately, though it's prospective, but the credit which was accumulated, which I had a right over it, that has been taken away. So in that sense, has a retrospective impact. And also, Brew, probably somebody can say that, look, foreign companies are not treated the same as Indian companies. Somebody might even challenge it on grounds of Article 14. So that's as far as MAT is concerned. Buyback, I really don't understand what's the necessity. It's back and forth. 46A old, again 115B Q you had, then you had an entire disputes of cognizant going on, then again back to dividend regime, and then again back to capital gain regime. So you are going back and forth. There is no certainty of what you're going to do. So we just hope that this again does not change, because this has implications, because these dividend aspects, these capital gains aspect had also international tax regime perspectives, right? A company who gets a dividend, a foreign company who gets a dividend from Indian company by way of a buyback, if it's to be treated, the tax rates are different. Cognizant used the Mauritius route to say that it is capital gains not taxable in Mauritius, so exempt me. Now that litigation is going on. Now again, you're changing back to capital gains regime. So right, you're going back and forth. In the last span of 10 years, you have done two changes and back to square one. So we do not know up to what extent it's going to be stable. So we at least hope that at least this time you keep it stable. So that's something which I would just add on.
And you kind of answered one of my follow-up questions, that do you think this provision will stay, or it will be challenged, and if it will be challenged, what are the possibilities of it, actually coming in force? And maybe Saurabh, I want to take your view also on the same.
Yeah, so I think Sandeep and Sai has covered most of them, and obviously, when this is implemented, people will find a fraction of people who would like to challenge it before various codes, and then we see how this new code evolves with time.
Okay. Sure, Akshit, let's move next. Thank you. Sorry. Next. Okay, sorry. And similar.
I think you have covered buyback. Yes. So this is simpler one where with respect to the submission of Form 15G or 15H. Now this is respect to only the submission by the individual person or any person where they want to submit the declaration for no deduction of tax. Okay, no deduction of tax where their income is less than the taxable limit to any companies for any dividend income, any mutual fund dividend distribution income, or income from securities. So any declaration given by the taxpayer to company, each company, for the income of dividends, income from any securities, income from any mutual funds. Now, the current rule was, as if I was a taxpayer, if I was any security holder, I need to give this Form 15G to each and every company separately so that I will not get any tax reduction. So which is a very cumbersome process. So this submission of 15G is each and every company where if I have shares across 100 companies, I need to submit 15G to each and every company. Now the new amendment was, they have shifted entire this to through any depository. If I submit my 15G form to any depository like NSDL or CDSL, then it's sufficient. So that submission of one Form 15G to any NSD or CDSL will make suffice. That is also through online, where I'll get lower tax reduction irrespective of submitting each different company. So making the process simpler. And where the depository will submit the same information to on quarterly basis to the Central Commission of Income Tax, where they will distribute the same source of income to all the respective companies. This is applicable to only for the listed shares and securities where I want to get the tax reduction, but not for any others. So where I have the multiple companies investments, only where this is on benefit. If you have any income from FDs, different banks, then the process is the same as there's no change in that. Okay, I think this is one of the interesting amendment. I think, yeah. So earlier, the first we will discuss about the income tax return due dates. So earlier we have July 31st is for normal SSAs who are not liable for tax audit, and 30th September is to file a tax audit report. 31st October is to file the income tax return who are liable for any audit under Income Tax Act or any other act. 30th November is for transfer pricing. Now they have made one more classification for the businesses, any person who are doing business, individuals or HUF, who are not liable for audit, then their tax return is 31st August. So now we have tax due dates for July, August, September, October, November. You have the cut every month, you have each and every one deadline. So they have they have spread August till last year. Now they have filled that also. And they have distributed the burden for all the taxpayers, July and August. That's one welcome move from the income tax department. The second is with respect to the belated return. Now this is one original return, which is where you can file July, August, September, October, November. Let's come to the belated return. Belated return now earlier you can be able to file till 31st December of the next financial year. Still it stands same. There is no change in that. Now for the revised return, the earlier due date was 31st December. Now that they have extended from 31st December to 31st March, but that is for the you have 12 months gap after the completion of financial year to file the revised return. And you can file the revised return for original return and also belated return. So the revised return can be filed, original return and also belated return, but they have certain late fee if you want to revise after 9 months, but 9 months to 12 months window. That is 1,000 for if the income is less than 5 lakhs and 5,000 if the income is more than 5 lakhs. And if any individual or any company where they are filing belated return and also the revised return. That means, for example, an individual who is filing the return after 31st July. That means it is belated return. Okay, now he is liable to pay late fee. If I want to refer old section, it is 234F. If it in old section, it is some kind of 400 series around. Okay, now the late fee applicable for belated return is 1,000 rupees. Now, if I want to revise this belated return after 9 months, that is after December 31st, then I want to pay late fee again. So effectively, to revise the belated return after 31st December, will attract 2 times fees. That is 2,000 rupees effectively. So that's how they have given it brief time to file the revised return, 3 months more time for that. Yes, and this updated return concept, whatever the files, if you are unable to file any income tax return within the specific due date, maybe original return or belated return, then you have the option to file the updated return. And earlier laws, the rules was if there is only additional tax payable, then only they can able to file updated. And the additional tax you have 25% if it is 12 months to within 12 months, 50% within 12 months to 24 months, 60% of additional tax if it is between 24 to 36 months, 70% if it is 3 to 36 months to 48 months. To file the updated, that is, I think, yeah, that is that one category was the taxpayer who were reported loss in the earlier years and they want to reduce their loss. If the earlier they have reported loss was 1 crore, now they want to update the return to make effective the loss was less than 1 crore. Now they're happy to do that. That is one amendment in the Finance Act, the budget 2026. And the second one, much welcoming amendment is on the they can able to file the updated return when they have the reassessment proceedings initiated. If the income tax department has initiated any reassessment proceedings, still they can able to file the updated return. But there is a 10% tax extra they are supposed to pay. That is, for example, if it is within 12 months, then 25% tax, whatever it is in the updated return, 25% plus 10%. That is, they were supposed to pay 35%. Okay. If the reassessment proceedings were started, okay, but the time limit to file the update is falls under 36 to 48 months. That is, then they were supposed to pay 70% what are the tax, usual tax, plus 10%. That is 80% was they were supposed to pay as the additional tax if they want to file updated return after initiating of the reassessment proceedings. That is one of the amendment. But the good part of this point is once you file the updated return after the reassessment proceedings are initiated, then it doesn't mean that the reassessment proceedings will not get abated. The proceeding will still continue. The only relaxation is the penalty, whatever they were supposed to impose for underreporting or misreporting, that is getting exempted. That's it. But all the proceedings will get continuous same like that. So to conclude that, update return, we have only two amendments. One is on the loss return, which they want to reduce loss, they can file that. Second thing is if they, even though reassessment proceedings were initiated, still they can able to voluntarily go and file the updated return by paying 10% extra additional tax. Yeah. So now if we just want to move to the transfer pricing segment where especially for the IT and IDA sector and all the information technology sector. Now if you want to go through that, all the safe harbor rules, APS, everything, this was not in the finance budget because this comes under safe harbor rules. It was announced in the budget, but always this will part of the rules. What are the rules, draft rules that was shared by the income tax department, which was in draft stage, which they have been inviting for the public comments. In that draft rules also, they have been incorporated in a way that we want to understand in a broader way. Earlier we have IT, information technology, IT enabled services, KPOs, contract warranty. For each category of business segment, the transfer pricing margins are different. That means the arm's length margins were different. One has 17%. If you take KPO, they have 70 to 24% as margins. And if you have contract warranty, they have 18% as margins. So for each category of the business sector, they have different profit margins they are supposed to declare. Now, they have consolidated all these four categories under one category, which is IT services category. And the safe harbor drastically low from what exactly we are at 17 to 24%.
So we lost you in the last few seconds. Maybe you want to repeat, you were starting to say about safe harbor rules.
Okay, my apologies for that. Okay. So the safe harbor margins, which is at 17% to 24% in the last all the four categories, so as they have all consolidated into one category, and the safe harbor margin also reduced to 15.5%, which is a significant reduction from the previous year margins. So that it is beneficial for all the companies to transact the international transactions where they have the 15.5% margin, where it's a good flow to the companies. And the safe harbor limit, which is earlier of 300 crores, now they have increased the limit to 2000 crores, which is approximately 220 million US dollars. So this 15.5% margin is applicable for the companies in the large scale, for a company says where they having the transaction value of $220 million. So such large scale company also, if they can able to maintain 50.5%, that is acceptable as per the new rules. This is one of the welcome move. And the safe harbor rules for each and every year, we need to file one application to the income tax department. Now, as per the new rule, if the safe harbor application can be opted for 5 years. That's where it is more beneficial for any software company, especially IT sector, where the TP margin got reduced and then consolidated. And also safe harbor margin was also from 17 to 24. All this consolidation of different services and also reduction of safe harbor margin and increasing the threshold limit and the increasing the span from 1 year to 5 years. This will make the TP transactions and more of IT companies much more easier.
This one, from a layman's perspective, who are the beneficiary for this change?
IT companies, the companies which are in IT sector, KPOs, who do service business, who do product developments, who do all having their holding company in US or subsidiary company, all who doing IT development services, all these companies are more beneficial for this.
Including Indian and global?
To add, just
Including?
to add here, so basically, sorry, just may I add, just so this entire safe harbor is a good thing. So the entire IT, like how Sai has said, the entire IT infrastructure, everything put together has been expanded, right? So you have software development companies involved, IT-enabled services, knowledge processes, outsourcing companies, contract R&D services, software redevelopment services. So the services expansion is very wide. Even the data processing, all that gets included. So what this will in practical sense will do is that in say Bangalore alone, right? The Karnataka High Court or even the Bangalore Tribunal sees flurry of litigations on ITES companies having comparable disputes and transfer pricing because of margins. You are fighting for one company to be excluded from the margin, and then you batter it around left, right, and center up to the High Court, Supreme Court. The batches of cases went to Supreme Court, went back to High Court. So this will ultimately reduce the entire litigation. So in litigation perspective, 50%, 15% margin, please go away with it and go by, because Bangalore has a is known for that, like the transfer pricing officer wanted to cap that, the margin should have been 20-25% because one company is making 20-25%. Right. So that's how the trend was. So now the reducing a limit to 15% is a very good thing.
Right. No, thank you.
Just one thing which is within the transfer pricing thing which they have done is the time limit at 60 days order, right? So this amendment is not intentional. It's not an unintentional amendment. It is a very purposefully made amendment and also with a retrospective effect, right? So this originated from the Madras High Court. So there was a dispute with respect to how 60 days needs to be calculated, right? So that the provision under section 92CA within brackets 3A, right? So that's the section within which the time period provides for a time period within which the transfer pricing officer is supposed to pass the transfer pricing order, right? So the section is worded in a way, I'll just read it out so that the audience has. It just says, I'll just read the main portion. It says the transfer pricing officer has to pass an order before 60 days prior to the date on which the period for limitation referred to in section 153. So 153 is a limitation wherein the final assessment order has to be passed. Let's say predominantly it is going to be 31st December on which the assessment order has to be passed, draft or final whatever. Right. So you need to calculate 60 days backward. And before that date, he has to pass the transfer pricing officer has to pass his order. Right. So in that set of cases before the High Court, all those transfer pricing of orders were passed on 1st November. Right. So we took a plea before the High Court, said no, it ought to have been passed on or before 31st October because the section is very clear. Our reading of section is very clear. It says what before 60 days prior to that date. Right. So 31st December is that, exclude that days, count 60 literal days, go up backwards. So 30 days of December, 30 days of November. You have to pass the order before that 60 days, right? So I'm just calculating backwards. So that before 60 days will come eventually on 31st October, right? So the High Court was in our favor. Matter traveled to an intra-court appeal also. That also found in our favor, assessee's favor, and the litigation is pending before the Supreme Court. So pending litigation before the Supreme Court, and then please be aware that everybody be aware that this is not some new litigation. This has been there from 2020, 2021. The orders of the High Court are as old as 2021, 5 years old. It took you 5 years to make this retrospective curative amendment. And also, you have not amended subsection 3A, 92CA within brackets 3A. That has not been amended. You have brought in 2 more amendments, like a permutation combination that if your 31st December is your last date of passing the order, then the date will be 1st November to pass a transfer pricing of order. And if it is 31st March, then it will be 1st of January. If it is a leap year, then it is another combination. So, right, you have done it. And interestingly, they have made an amendment to the 2025 Act also to this tune, right? But giving 2 illustration, but reiterating 31st October as the date on which the order ought to have been passed. So, I really don't know. Either it's a drafting mistake or the intention was very clear that 31st October is the last date for the transfer pricing officer to pass the order. And the fact that even the department circulars, right, the department instructions, internal instructions to the transfer pricing officers, which we placed before the High Court, they also said very clearly 31st October is the date to pass the order. Right? But ultimately now the things that you have the retrospective amendment trying to clarify. Probably this will also lead into litigation. And the other aspect of another retrospective amendment to transfer pricing and the international tax with respect to eligible assessee is that the time limit within which the entire assessment has to be completed, right? So we covered one set of dispute of 60 days, which popularly known as, just for audience reference, those are popularly known as the disputes arising out of Pfizer case, Pfizer and Saint Gobain from the Madras High Court pending before Supreme. The second set of amendments which affects the transfer pricing industry is the ROCA amendment, the ROCA bathroom, right? So although the ROCA bathroom has become a popular legal brand, whether their product sells or not, but everybody in the transfer pricing regime or even before the tribunal, everybody, I have raised a ROCA ground. So this is where it is. But now, that's a very interesting read on that. So the timelines also with this all 2021 judgment, and now after 5 years, we have amended it. So just to give a brief background, ROCA bathroom, the dispute was a very different set of dispute. It was a case of remand by the tribunal to back to the assessing officer and the transfer pricing officer. After 4 years, the transfer pricing officer did not issue a notice. The assessing officer did not issue a notice. The DRP sends a notice after 4.5 years saying that, look, tribunal has directed it. I want to make an amendment. Roka went to the High Court saying that now you cannot make a assessment now. It's all gone. It's 4 years beyond the time period within which the since when the tribunal passed the order. So High Court said yes, it's 4 years gone past, but we will quash the order. The matter went on a inter-court division bench before the High Court. Before the High Court, it is the revenue who said that everything, the transfer pricing officer's order, the draft assessment order, and the final assessment order all has to be passed within 153 limitation, which is 36 months, 33 months as the case may be, depends on year to year. And then you go to DRP, which is the dispute resolution panel, right? So if you are aggrieved by the draft assessment order, you can go to a dispute resolution panel if there is a transfer pricing adjustment. The dispute resolution panel has 9 months to pass that order, right? So the department wanted to say that, look, there are separate timelines. 153 gives 33 or 36 months. And then there is 144C dispute resolution panel, which gives me 9 months plus 1 month to pass the order. So I have a broadly easy for around about 40 odd months to pass the order. The High Court said, no, sorry, you can't do everything in this 40 odd months long, 40, 50 odd months long period. You have to do everything within the time prescribed under 153. Right, so that is what the High Court held. Although that was not even the case of either the assessee or the revenue before the. It was not the case of the assessee, but revenue wanted to argue it. So that went to Supreme Court. Supreme Court, in a hearing, gave a split verdict. One judge said yes, revenue is correct. One judge said the assessee is correct. Right. So that dispute was not queer Roka, was queer another assessee. But they wanted to argue that in the original proceedings, not remand proceedings. So that's the differential part. So now you have amended this 153, 144C retrospectively to clarify the timelines within which a transfer pricing officer has to pass an order, a draft assessment order has to come, and the DRP which has to pass an order. Again, the timing, it's very sad that you have retrospectively amended it. And although pending litigation before the Supreme Court, there is a split verdict, and that's the situation which stands, right? So look at the intention. Like when you had the regime in change of regime in 2014, Mr. Jaitley said that this government will not make any retrospective amendment because of the Vodafone hue and cry, right? Then again, 2015, 16, Mr. Jaitley kept reiterating that no retrospective amendments anymore. We want tax certainty, right? Even again in 2016, 21 also, Mrs. Nirmala Sitharaman also made that assurance. Then you withdrew the retrospective amendments. But now you have almost about 5 set of retrospective amendments by the Finance Bill 2026, all overruling disputes pending, which are as of today pending in the Supreme Court, right? So that's where things stands today, which is certainly not in a good taste. So, but this is where it is. Obviously, people will challenge it, not challenge it. The time will tell us. But this is where the entire transfer pricing litigation trajectory is sought to be put to an end. So this is something which is really good as far as industry is concerned, and especially the data center aspects as such. So I just put it into 3 different buckets right now with respect to foreign investment perspective and with respect to India needing the foreign expertise, right? So first, let me just stick on to the expertise required, right? So generally in India, the foreign experts were averse to traveling to India because of 2 practical difficulties, right? So today, if you want a foreign non-resident who has expertise to come to India, so he would not want to stay more than 60 days or more than 181 days. So he ensures that he remains non-resident and not being subjected to Indian taxation system. Right, so he always used to plan it. So you had a resources of a foreign country expertise always throughout. Right, so now you brought in an amendment that with respect to global income of foreign experts, right? If a foreign experts can come to India, can stay in India for 5 years, continue to be, although resident for Indian tax purposes, only Indian income will be taxable in India, and his foreign income or his rental income or interest income or capital income, which is earned outside India, will be taxable outside India and not probably in its source country and not in Indian. This will have a practical difficulties, but it's a good move in that sense, right? The second advantage, what that individual get is certainty, right? He doesn't have to go back for any routine that to ensure that visa stamping and all that. So this is something which is respect to which we can garner from foreign experts, right? Now, second aspect is with respect to data centers. Now, data centers, you have brought in a complete new exemption regime, right? So now this data centers will be operated by an Indian company, but data service provided by a foreign company can be done. And who are providing foreign data provider services from foreign company, they will be completely tax-free. You have not put them into a deduction chapter, you have put them into exemption provisions, right? Like erstwhile section 10, you have put them in schedule 4 now. Erstwhile section 10 is going to be schedule 4, schedule 2, 3, 4, the income tax act. So you have put them in exemption category up to 2047, right? So that's a good thing as far as foreign data service providers are concerned. Now, what this entire structure is going to be that the assets, the data center assets have to be owned by an Indian company. So obviously a foreign company will set up an Indian company, create the infrastructure, sell the services to Indian people through Indian resellers. So all that income will be taxable only in India, no difficulty. And the foreign service provider who's providing services through these data centers to a person located outside India, he will get the entire exemption, right? So a foreign data service provider using the Indian data infrastructure to provide services to foreign recipients, not taxable in India, have a data center, Indian reseller, the data center will provide services to an Indian reseller to Indian residents. That will all be taxable in India. So what this does is that it has a double advantage, right? From an international tax perspective, tomorrow nobody can say that this data center is a P of the foreign service provider because you have carved out an exception under under schedule 4, right? So in that sense, it gives an advantage. It gives a stability also to the infrastructure provider that they can invest in infrastructure through an Indian subsidiary and still get the services from that Indian infrastructure, which will become tax-free. So that in both way, for domestic purposes also, and international tax perspective also, PE perspective also, it's a good move. Right. So similarly, you also have certain other exemptions also. And in terms of minerals also, you have expanded the list of minerals to give benefits also. And then you have also IFSC units also, similarly for them also 100% deduction for 20 years and 25 years as the case may be. So overall, infrastructure boost, digital boost, it's a very good thing getting foreign expertise to do all these things. Yeah, we are in an AI boom. We need data service provider. We have regulations in place. All that is very good for this thing. And one caveat for all these things, these data service provider, foreign experts, these are all still in pipeline because you still have the schemes to be notified, right? So the real devil probably will be there in these schemes. So we'll have to properly wait for the actual scheme to come for the foreign investor to put in his money in the data centers or the foreign experts to be visiting India. So you have other benefits also with respect to, I'll bucket these 5 categories. Let's put it first with respect to the TDS to be deducted. There is a wholesale rationalization or TDS aspect as well as TCS aspect. In terms of TCS, tax collection at source, you have completely rationalized to more or less to 2%. So few of the services which were at 5, 1 or 2 as the case might be. As far as TDS is concerned, with respect to motor claims, accident tribunal claim, where you are supposed to get interest and compensation, no TDS to be detected. It's a good thing. There was unwarranted litigation going on, whether it is a nature of capital receipt or it is nature of revenue receipt, whether TDS ought to be detected. Earlier, there was a cap of 50,000, no TDS. They have done away with all that. Good thing, no difficulties, right? So that's good. Compulsory acquisition, wherever the government sees to acquire property from agriculturalists for any infrastructure development, you have a legislation in place, RF and DACR. So you have that act, any acquisition made through that act, no TDS to be deducted, right? So that's as far as TDS and TCS are concerned. Security transaction tax, yes, you have increased the STT only for future and options. Fine, people who want to speculate, who speculate the market, nothing for them because it's a added incidental cost. But although there was an impact on the stock market that day, but I think people who are into speculative market, I think this is negligible as a change. And then you have this DIN document identification number, right? So this is also a controversial amendment in that sense because you have amended it retrospectively from 2019. This also arises out of various disputes across the forum, right? The only good thing about the DIN amendment is that DIN amendment was not earlier there in legislation, it was by way of a circular. So what government did by way of a circular is like, please look, assessees, kindly see, and they inform the assessor that if you file a document or if you have been given an order or any communication without DIN, please throw it in dustbin, right? So DIN, no DIN, go to dustbin. So that's what long and short of the entire DIN controversy. So wherever the orders did not have a DIN quoted in it, tribunals quashed it, High Court quashed it. Matter is pending before Supreme Court. Now they have retrospectively amended it by introducing 292BA. So what that amendment does is any errors, mistakes in quoting DIN in the order shall not treat the document as invalid. So they are kind of validated, right? So it is only a partial amendment, only protecting like proper clerical mistakes, omissions of that kind. If a document does not have a DIN at all, anywhere not traceable, the document continues to be not valid in law, right? So what was the necessity to bring in 2019 such a particular technology-driven DIN in all the orders? Only to ensure that the assessment orders are all not backdated and physically signed, right? So today we all have a digitally signed assessment orders sent to your email. So only to stop that practice, so ensure transparency, you had a DIN, but you have slightly diluted it by way of this amendment. So these are all miscellaneous buckets of amendments which are proposed, some good, some bad.
So now let's move to the important aspect, decriminalization of litigation framework. Sort of, I would want to invite you here to pick this up. And also, I would like to hear your thoughts. What is the government intention behind it? Because I'm seeing government attempt on decriminalization in many other laws. Is it in the same line? Because there are mixed opinion when it comes to taxation, because their policy, uncertainty is sometimes there. As Sandeep was talking about that, there was a time when we were talking about there will be no retrospective changes. Here we are again going back to this. But is this thought process aligned with the broader thought process and how it is going to span out for I would say not from an individual but from the company corporate standpoint, and how are people going to see this?
Yeah, so hi, good evening, everyone. So as you're rightly saying that this is, this entire decriminalization and litigation framework comes within the vision of Viksit Bharat 2047, as India is celebrating 100 years of our independence. So government is reworking on a lot of laws, especially on laws which were made during colonial era of British era. And they want to get away with those laws. And in fact, initially I was also involved in the exercise where we would discuss on a lot of existing laws which were not applicable today because the entire scenario has changed in last like 75 odd years, and we need to bring the laws. And currently, like now AI and other things are coming, so law evolves on a very regular basis, and we want to change. And so is this income tax. Income tax also government want to come to people, bring people together, people friendly, get their involvement rather than bringing deterrent to the taxpayers. So before I get into this new proposal, I would like to take you back on the earlier law which was there in 1961 Income Tax Act, and chapter 22 talks about or deals with prosecution of tax evasion. And tax evasion is a very wide subject, and more particularly I have dealt or seen cases involving tax deduction at source, TDS. And most of this prosecution or lately the compounding offenses and all that started with TDS provisions, and especially this got momentum, especially at the time of COVID era. So I've handled a lot of this prosecution matter during which arise during COVID era because of a lot of financial burden or insecurity or complexity which arise suddenly due to COVID lockdown. And earlier the prosecution side of the Income Tax Act talks about rigorous imprisonment and hefty fines, which starts from 3 months up to 7 years. In some cases, in Black Money Act and all, even it goes up to 10 years. So these are all very deterrent, and even from income, because now I represent Income Tax Department on prosecution side. So I even see a lot of issues on the prosecution side, the clarity, the time it takes, all those things doesn't yield the kind of result which Income Tax Department or Government of India Ministry of Finance was looking at. So now Niti Aayog on 10th of October 2025, the think tank of India came up with a consulting paper on title towards India's tax transformation, decriminalization and trust-based governance. So they want to put more trust on people. And even if you see in last 10 years, I mean, earlier I was part of Big Four and I was on the litigation side of the Big Four. But if you see last 10 years, Government of India, particularly income tax, CBDT, has taken a lot of initiative to, be more tax friendly. Plus, a lot of initiatives have been taken, like faceless assessments and all those things. So to reduce litigation and find a midway where both taxpayers and income tax departments comes together and find a solution. So thereafter, the old act uses criminalization of law to ensure compliance, as monetary compliance was not enough for a lot of taxpayers. So they came up with this idea. Then eventually compounding of such offenses was introduced, and a lot of people went to court because criminal law got the jurisdiction in dealing with those kind of prosecution. Special wing within Income Tax Department was created. Special lawyers like me were appointed to deal with those cases on day-to-day basis. However, there were a lot of genuine cases also, like in TDS cases, we have seen a lot of genuine cases also where Income Tax Department would also not want to prosecute, but because the law was very, very rigid. So we had discussion with a lot of income tax officials to the senior level, but obviously the law was very straightforward. So they did not bring any solution, even if I had a bona fide reason to delay in payment of TDS, because TDS, once you deduct, it's not your money, it's government's treasury's money, and you have to deposit that money into the governments within a given stipulated time frame within the 7th of next month. So all those things led to a lot of deterrent, a lot of disconnect between taxpayers and Income Tax Department, and thereafter this Vision to Viksit Bharat 2047 came, and government has talked about decriminalization for other laws, like including Companies Act 2013 and other laws, to make it very simple and people's friendly, and people should come forward to take benefit of this. So in this report which I just mentioned, there are total of 35 criminal offences under income tax proposed under Income Tax Act 2025. 12 offences were fully decriminalized, and civil or monetary penalty should be enough to levy on those, where there are more on a procedural lapses than any intentional or mens rea is there in paying your taxes or dealing with your taxes, or any intentional error. So procedural lapses, like you have forgotten or you miscalculated, or there's an interpretational issues from a taxpayer side or their tax consultant side. So all these things have been, fully decriminalized. You pay penalty or you pay civil remedies, and then you are done. Then 17 offenses retain criminal liability and for fraudulent or malified intent, removing sanction from good faith procedural lapses. But again, this would be, dealt with matter of facts, and again showcasing or showcasing your bona fide intent, and all those would also be, tested with time, and we'll see in future how many litigation is coming to. And then we have 6 core offenses, including deliberate high value misconduct to remain criminal subject to proportionate punishment. So fear into the mind of taxpayers would reduce, and bona fide errors without malicious or fraudulent intent should be decriminalized and addressed through imposition of penalty or civil remedies. So this is the basic idea about the entire decriminalization of offenses under income tax act.
See, so sort of one very, one question in my mind, which is not related to the subject, but more from your experience of working closely, being a prosecutor here. See, many times we've seen the laws have an intent, and the regulator, government has an intent of decriminalization on many parts, but this information and this intent doesn't trickle down to the ground level. So the inspector I'm dealing with may have a different approach towards it. I'm not saying maybe the law is same, but the approach is different and that's where I would say, specifically in tax laws, companies have to spend a lot of time, money, effort in dealing with these litigations. What are the focus? What is the effort towards bringing some kind of a sanity and parity there?
See, obviously, when implementing this kind of changes suddenly would have a practical implication, and because India is very wide and different income tax offices may have different implementation. I'll give you a very practical example, not from income tax act, but from other criminal act. And I was there in Karnataka yesterday and day before yesterday. Law is very clear on lien of money, that the crime happened, the money transaction of money in layer 1, 2, 3, 4, 5, 6. The police can only freeze or mark lien on the amount involved in the criminal act or proceeds of crime. But unfortunately, and there are multiple legal precedents in last 2 months, 3 months, and there has been, people, police also know that the Supreme Court has said this, different high court have said this, but implying it on the ground is, everybody's. I mean, I was there in Karnataka yesterday, and there was a fraud of 2,000 rupees, and my 4.5 crore rupees was frozen, mark lien by the local cyber police station. Had I gone to High Court and again take an order against, and law is very well covered. But obviously, we rather thought to go to the local enforcement agency, met the senior official, and we got our lien removed within like few hours. So this practical thing would definitely come, even for income tax. Law will evolve, a lot of case laws will come, and it takes time. See, income tax act, earlier income tax act 1961, lot of issues got settled even for international tax in last 10 years, 15 years. Like authority for advance ruling was there, then it become very toothless, and then you got a lot of other things. GST AR was introduced, but I did not see much effective because I fought a case on a similar ruling given by authority for advance ruling in GST, and I was there in Maharashtra, and we faced a lot of challenges. So obviously on ground challenges would be there, but the intent of government is very clear. It may take time to show it to the ground level, but obviously today or tomorrow we will reach there. So I'm very positive, and great initiative, great suggestion by Niti Aayog that we need those kind of things to improve, bring people more closer, because a very few fraction of people in India pays taxes, and especially the middle class or salaried class, and they are the one who are prosecuted or who are held liable. Otherwise, you see the ratio of people paying official taxes and all that are still very, at a lower side. So this will encourage other people like you and me and everybody. And as you rightly said in the beginning of the this that this will cover everybody, you, me, everybody, so in one way or the other way. So very important introduction, and even uh, the senior government officials are very positive about this. But this is a matter of testing time and how this will come.
Thank you. That's interesting to understand. What the government's intent, because I completely understand. But if the intent is right, India is country of 140 crore people, and it's not easy to pass on us information in such a large organization. I'm saying is when we are dealing with a smaller organization of few hundred and thousand people, bringing everybody on the same page in terms of your policy adherence also is not easy. Here we are talking about a country of 140 crore people. Let's hope the intent goes to the ground faster.
Sure. I mean, it may take time, but it will surely go there, for sure. So again, this was introduced under Union Budget for Foreign Assets of Small Taxpayers Disclosure Scheme, FAST DS 2026, where 6 months will be given for voluntary disclosure of your assets or income outside India. And if you go back, similar thing were introduced when Black Money Act of Undisclosed Foreign Income and Assets Act 2015 was introduced. Similar time frame was given that if you have any undisclosed income or assets outside India, you come voluntarily disclose. We'll close it. We'll give you 30% tax and 30% further tax, and we close everything. Otherwise, it's 30% tax plus a 90% penalty under Black Money Act. And this has again become a very deterrent. Sometimes it's intentional, and I'll give you a small example. I've been staying out of country for many years, and yesterday while preparing for this, I had to write to all the bankers outside India that if I have any money pending in my account or not. So these are very small, initiative that you can take. Come forward, surrender yourself, and this is more done from a perspective of students, young professionals, for whom across jurisdiction has become very mobile. So they work for some time from here, sometime from other country. Tech employees who are sent out of the country on secondment for a few years, and then they come back. So they get their local salary outside India, and all those kind of people. So this will definitely help people to come forward. And if you do not, and I would suggest everybody, whoever is listening to this webinar, that if you have, or if you any of your relatives, friends, because I am dealing with a lot of those kind of matters, and not only from income tax perspective, but also from income tax, black money, and FEMA, ED. So all those things become very, very complicated and very difficult to handle on ground as a lawyer or as a legal consultant to the companies. And there are certain changes. Eligibility of schemes: Indian resident in relevant period satisfy the conditions specified in the scheme, includes person who are presently non-residents or NOR, but who are Indian resident when undisclosed foreign income accrued, foreign assets were required. People who can take advantage, as I discussed with you, like employees of MNC receiving ESOPs or RSU from foreign employers, and such assets are not reported. Former students retaining dormant low balance foreign account. Like I gave you my own example that I wrote to couple of my bankers outside in India that please check whether my account is still valid or not valid, if I have any money, because it becomes very difficult for me to keep a track. And I have been traveling to different countries, including African countries. So I had to write to them. And then this has different category A, category B. Category A is who did not disclose overseas income at all. So there you have eligible if undisclosed income or asset up to 1 crore. So obviously, I think threshold limit would increase with given with time frame, because 1 crore in current scenario is a very small amount the kind of money we as Indians are dealing in today's era. So 1 crore, but nonetheless, it's a welcome move. It starts, and then tax payable is 30% of the fair market value on of the asset or undisclosed income, plus 30% as additional tax payable in place of penalty. Earlier it was 90%. So obviously you save on those kind of things. And again, penalty or going through black money is not a very easy or very pleasant experience. So this will save you, and especially for small taxpayer or students and all those. And immunity from further prosecution. So this law is very specific that, because earlier there was some confusion that even if you pay the penalty, you cannot be earlier it could be part of reassessment and all, but now it clearly brings a finality that cannot be reopened in any subsequent years or reassessment in future years. So this becomes finality to the income that you disclose under this scheme. Category B is who paid taxes on overseas income but failed to declare the asset acquired from those income. So asset value up to, so this has gone up to 5 crore, and which is a decent move, because obviously if you acquire any asset with a movable or immovable, would not be like a small. So 5 crore is a very decent amount. Payment of one time fee, you make payment of one-time fee of 1 lakh, and you get immunity from penalties and further prosecution. So I think this is a good move, and people should be aware. Income tax department should also make some road shows to people to teach them, educate them, and try to bring more and more people to take advantage of this scheme. And still, I mean, it hasn't been in effect yet, and there will be further rules, further forms, and all those will be introduced with due course when this law, the entire law of income tax, will come into effect from 1st of April 2026. And thereafter, obviously, we'll see a lot of changes, a lot of actions in this domain.
So just 2, 3 quick questions. One you have already answered. So, can I make declaration of multiple assets in multiple countries and different type of assets also? One of the scenario you also pointed, I may be a person, in a genuine case working with an MNC, have been posted in different countries over a period. Maybe have made income, made assets in those places. Can I declare all of them at one go?
No, so law has clearly given a threshold limit. So that's why I said, with time, this threshold limit would go up or on upwards. I see going on upwards side, because up to 1 crore under category A or up to 5 crore in category B, and people in today's era have become very mobile, traveling from one place to another place very quickly. As you give an example that I'm working for an Indian embassy or Indian government posted outside India. So this 5 crore or 1 crore will maybe not very effective. But yeah, it's a good start initiated, and eventually it will, the threshold limit will go upward. And this is my gut feeling.
And the last one is, how do I understand the fair value of my undisclosed foreign asset? I may have bought a real estate investment. So is it a value of today or a value of when it was investment was done, or what is the methodology here?
No, so I think those procedural aspect has not been covered yet, because I think there will be some rules or some forms would be introduced, and basis on that they will give you a parameter. Even today, for FEMA practices, I mean, when you acquire income or assets outside, so you have to have those practical challenges, and you have to get those valuation. I'm doing a matter for one of a large listed company promoter, where he invested more than 100 crore rupees, say 12, 13 years back, and today that value has diminished to 0%. So today I do not have a valuation, but obviously the money went from India to outside in 2012, 2013, worth 100 crore rupees, and further invested in creating assets. Today those assets are not there anymore in the books of accounts. So all those things will have a practical challenge, and that will be a discussion. So today, if I go to RBI, we have a different point of view on valuation and all that. So again, in income tax also, it will be a challenge, but obviously there would be some rules which will be framed to discuss, deal with all those kind of issues. But it's too early to, comment anything on, to be very specific. Your question is very specific, and at this point, nothing is given on clarity on this kind of aspect. So maybe they will issue some FAQ or all those kind of things is expected.
So government sort of
Add to that, in the current, if you understand the schedule FK, which is an income tax return, which we follow, so they give the opening value, the peak balance, and the closing balance. So what are the fixed foreign assets that any company or individual possess? They're asking for the opening balance and the peak balance, not the fair market balance. So they're more concentrated on the peak balance of the bank account or custodian account or the equity shares, whatever they hold.
But that's an interesting move. But more on the lighter side, I said, government of India is planning to give run for money to the Swiss banks. So hopefully we don't need DeFi's in the coming year. That's the law. But yeah, pretty interesting conversation here. And more I was listening to you all, I realized that we just trying and we are just scratching the surface right now. This subject is too deep. And I think on one slide where we were trying to rush in 5 minutes, there was a lot which had to be spoken on those contents. And I'm sure as we talk more, people will have more questions. But this was a very interesting conversation. And I think we have already surpassed the time. It's 5:33. But we didn't realize it's already too late. And thank you so much for this for your time today. Just want to, before we wind up, just want to pick up any of your closing remarks, sort of, Sandeep, Sai.
No, so I think this is a great initiative, and this has been, part of discussion for many years in budget, pre-budget, industry association. That as Sandeep and Sai already mentioned, that there are multiple amendments introduced in every financial budget and all those things. So it's a great move that we are moving ahead and taking recourse from different jurisdictions. So it's a great move. We'll see how it is implemented with the same intent.
And I believe this is very much in line with the government intent. But what I'm seeing, and in other laws also. When recently there was a change in the RBI regulations, government try to consolidate everything, make it more simpler, from that matter. Similar, I think we are seeing in SEBI regulations also. Labor code is another example. But I don't know how much, whether we are, as a corporate, we are able to choose so much at one point of time, because it's happening at a very short interval. But I hope regulators keep it simple from that
No,
perspective.
Jayant, what I would say, I've been dealing with Ministry of Law and Justice also many times. So this is not a very short span. Lot of thought process has been given for a lot of time, and it's the larger picture is Dixit Bharat 2047. So still we have a long way to go. A lot of thought process, lot of industries, comments and all those things are also been, gathered. We were called by Ministry of Law and Justice to, discuss on certain arena of laws where, we wanted to recommend, give our suggestion and all those kind. So a lot of background. I mean, we as a professional do not get into the, detail or technicality, but a lot of things are being done at the background of the entire changes.
That's encouraging to hear, and that's something it's coming from you. I'm sure you have a lot more insights than we have. So hoping for more positive developments on these lines. Sandeep, you want to say something?
Yes, so let's, as far as professionals are concerned, yes, there are lots and lots of work coming in, new act, new opinions, new consultancy, new advisory. So it's going to be rolling. And budget every year, the landscape of the budget is good, the vision is good, infrastructure development, whether it is transport or shipping or even the data services. So all that is good in the long run. Yes, by a decade or two, we will have a better infrastructure. So that's something which is really positive about it. In terms of litigation, yes, the word itself is speculative. So that's going to be there forever.
So if you come to under the overall the view of the budget, they're more concerned with what is necessary for India, with respect to data centers and the more of the manufacturing of pharma and medical devices. Because having the global crisis across western part and other parts, so where the India is core, the India's strengths, we are playing our strengths. That is the IT and also the pharma. They have given good incentives, good weightage on that, which is very welcome. I really appreciate on that part. And with respect to all the regulations like labor code, other regulations when it comes to payback, whatever it is, it's like procedural aspects where they change the regulations for some time and then they'll again reback. Because we as a professionals, as per Indians corporates, will try to invent new loophole and then government again want to plug that. So it's always a cycle will go on, go on, go on, go on. So that's how the Indian legislation has become this book to this book.
Right. No, but thank you so much. And I'll not hold you back for long. And thank you everyone for your patient hearing and participation. And look forward to the next session. And we will circle back with the agenda, and we'll come back to you sooner with the time and date for our follow-up session on the same topic. Thank you, Saurabh. Thank you so much. Thanks,
Thank you.
Sandeep.
Thank you for giving this opportunity and
Thank you
interacting with
for your patience, audience.
Thank you, Raj. Thank you.
Thank you.